Big news in the cable world, Charter Communications is merging with Cox Communications in a $34.5 billion deal. This creates the largest cable and broadband company in the U.S., with roughly 38 million customers, even bigger than Comcast. For investors and viewers, the key question is, what does this mean for Charter's stock, ticker CHTR, in your portfolio? In today's video, we'll break down the stock reaction, expected benefits, and risks, and what retail investors should watch in both the short term and the long term. Deal overview. Charter agreed to buy privately held Cox in an all-cash and stock deal valued at $34.5 billion, about $21.9 billion equity plus $12.6 billion debt. Cox Enterprises, the family-owned parent, will roll a chunk of equity into the new company, keeping about 23% of the combined shares, and will also receive cash. In practice, this means Cox's commercial internet and cloud business transfers to Charter, and Cox's residential cable arm is contributed into Charter's holding structure. Eventually, the combined company will rebrand as Cox Communications, using Charter's Spectrum brand for customer services. Market reaction, stock price. Investors reacted positively. On news of the merger, Charter's stock jumped by about plus 4%. In fact, CHTR was already on a hot streak. It's now trading near its highest levels in over a year and is up roughly 50% year over year. Options traders even saw heavy volume as they bet on further moves. In short-term trading, Charter shares hit multi-month highs, reflecting excitement about the deal's scale and future growth prospects. By comparison, Cox is private, so there's no public Cox stock price. Synergies and growth. Management claims the merger will unlock major cost savings, about $500 million annually within 3 years. These savings come from combining operations, consolidating network maintenance, purchasing more cheaply, and reducing overlapping staff. Investors like synergies, because they suggest higher profits down the road. Charter's CEO promises the deal will allow the company to bundle TV, internet, and mobile services on a larger scale. A bigger company can negotiate better with content providers and leverage its size for deals. Risks and regulatory hurdles. However, there are risks. A big concern is regulatory approval. This deal is the first major cable merger of the Trump/Biden era, and antitrust regulators are watching closely. The Justice Department has stated it will scrutinize any merger that decreases competition in ways that harm consumers. By some measures, the combined Charter Cox would dominate certain regions, potentially acting like a local broadband monopoly. Analysts note that while Charter will be the top pay TV provider, it's the broadband side, internet service, that really matters to consumers, and a single giant provider could be worrisome for competition. If regulators demand concessions or even block aspects of the deal, that could affect stock performance. Another risk is debt load. The acquisition adds about $12.6 billion of Cox's debt onto Charter's balance sheet. That means higher leverage in the short term, though management expects to manage it. More debt can pressure the share price if growth stalls. Short-term versus long-term outlook. In the short term, stock volatility is likely. The initial jump shows optimism, but investors will be cautious around any news on regulatory review or integration issues. Charter also plans to close its Liberty Broadband acquisition at the same time, so a lot is happening by mid-2026. If you're a retail investor, watch upcoming earnings calls and regulatory filings. In the long term, if the merger goes through smoothly, many analysts see potential upside. A larger customer base and the promised cost synergies could boost earnings. The combined firm may be better positioned to compete with streaming and wireless providers. Charter's leadership argues that the merger will help deliver high-quality, competitively priced products and even save consumers money. The stock market seems to be giving Charter the benefit of the doubt, reflecting confidence in long-term growth. Investor takeaways. For beginners, here's what matters. This merger is major news, so expect media buzz. If you already own CHTR, the deal looks positive on price for now, but keep an eye on integration costs. If you're considering buying, remember that big deals often start with a pop and then settle. It may pay to do research on Charter's valuation, potential synergies, and any regulatory news. The core idea is that Charter is betting on scale, that a bigger company can fight cord-cutting better than smaller ones. As with any stock, diversification and patience are key. Conclusion: the Charter-Cox merger is a landmark deal in cable/internet. Charter's stock reacted positively, up 4% at announcement, and analysts point to massive synergies, $500 million cost savings, and a leapfrogging of Comcast in subscriber count. But regulatory approval is not guaranteed, and the market will be watching closely. We'll keep you updated as things develop. If you found this analysis helpful, like and subscribe for more Smart Money sends updates on stock moves and financial news. Stay smart, stay savvy.